Investors Singapore. I'm Brian Fernandez, and it's Wednesday, the 16th of October, and we have Craig Erlam, Senior Market Analyst at Oanda, coming to us out of the UK. Craig, welcome to the show.
Thanks for having me on.
Now, Craig, before we get your insights, as always, let's take a look at how the numbers are shaping up across the region. But we start with cryptocurrencies. Now, Bitcoin is at 16,904. It's up 0.81%. Ethereum is at 1,257.67. It's down 0.07%. Now, looking across the regional stock markets, we've got the Straits Times Index, which is down 0.06%. Bursa Malaysia is down 0.55%. Shanghai is down 0.31%. The ASX All Ordinaries is down 0.34%. Bucking the trend is the Nikkei, barely with just up slightly, 0.04%. The Hang Seng is down 1.3%. And rounding up the numbers, we've got the Kospi, which is down 0.52%. Pretty bleak numbers. Please tell us why, Craig.
Well, I think there's probably a few factors. I mean, we can't ignore what happened on the Polish border yesterday. That really shook the markets up. We were on a really good day, and that quickly changed. Of course, the US still did end up higher. So once the dust settled a little bit, I think we did see maybe a little bit of that more positivity return, which, I mean, the fact that it happened so quickly, I think is a little bit surprising, but maybe not enough to take Asia out the red. Broadly speaking, I think it's going to be interesting to see how we continue to trade over the next couple of days. It will all depend really on the rhetoric coming from those NATO countries, but clearly in the short term, it has weighed on the Asian session. Of course, this is, especially when you look at China, for example, we are coming on the back of a lot of positive news with regards to these property measures, what we discussed on Monday, the 16-point plan, but also the plans on COVID relaxations and the prospect for more in the spring of next year. We've had a lot of good news being priced in, and at least the prospect of good news being priced in two key areas of weakness for China over the course of this last year, even when you're looking at the COVID situation the past 2 or 3 years. So this maybe has been a bit of a setback on that front. But really, as far as how we trade today and how we go into trade into the end of the week even, it's very much going to depend on the rhetoric that we get from NATO and how it views those missile strikes which landed on the wrong side of the border.
Now, speaking of those missile strikes, obviously your view on oil prices would have been changed somewhat since Monday. What are your thoughts then in terms of oil markets?
Well, do you know what I mean? When you look at the price of oil today, and we look at how the price changed yesterday, we're not dramatically different at this point. And that may be a factor of waiting to see what the rhetoric is from NATO countries and how they plan to respond, and also what we hear more from the Russian side as well. But I mean, we haven't seen a huge reaction. I think if we do see this now start to escalate, then I would imagine that we are going to see a spike in oil prices because of what that will do as far as Russian crude is concerned. Russia is still one of the largest producers of crude oil in the world. So, I mean, there's going to be a large consensus that it can't just be cut off. But a case of how it's managed and how it's dealt with would be a matter of insignificant uncertainty. Of course, there are countries that continue to buy Russian crude at this point in time, so I'm sure it'd be quite difficult to get an overall consensus. But that uncertainty is always what can cause at times the most volatility in these markets. So let's see what the rhetoric is from NATO today, but it's certainly a huge upside risk for oil prices.
Now, Craig, uncertainty again in another space, the crypto markets. So besides the FTX collapse, we're now hearing rumblings around crypto.com. What is your view on this? And despite the fact that Bitcoin and Ethereum in particular have rallied quite significantly in the last couple of days.
Yeah, I mean, this was always going to be the concern, and I think it remains a concern even beyond crypto.com. I think what we've got to kind of understand is that there's two things that could potentially come out, or at least two things that could potentially come out of this FTX story. You've got the fact that there could be implications for other either exchanges or other firms tied to FTX, either directly or indirectly through holds of the FTT token and the impact that has on their own balance sheet. And that is still something that we'll continue to see unfold, I feel, over the coming days and weeks. And then there's other issues that it causes within the industry in terms of people looking a lot more closely at where these similar types of vulnerabilities lie, and whether there's going to be any reverberations from that perspective. I think I mentioned this on Monday, that famous Warren Buffett quote, when the tide goes out, you see who's swimming naked. And I said, I think this feels like a very much a tide going out moment for cryptocurrency. And this is still a relatively new area. So we haven't really had one of these moments up until this point. And this still remains very much the case for me. We're going to see which places have been mismanaged, where there is potentially any corruption, where there is any significant vulnerabilities, and what's happened to the price of cryptocurrencies since this FTX unfolding has not made that any better. In fact, it's going to pile on the pressure further, and the more we hear about issues and vulnerabilities in the space, and if we do see cryptocurrencies fall another 20, 30, 40% over the coming days, weeks and months, then those issues are only going to become there's going to be a microscope on this space in terms of trying to look and seek out where these vulnerabilities lie. So that's a major concern for me, even if we have seen Bitcoin, as you say, bounce back a little bit over the last couple of days.
Now, a quick final question. In your notes yesterday, you talked about the key takeaway from the RBA minutes was that forward guidance will no longer be a tool that the central bank leans on unless there's value in doing so. So that's really quite a key point. How does this then impact our Australian investment strategies?
Well, I think we have to go back to the good old days a little bit, as I think is the real takeaway from that. I mean, forward guidance has been something that we've become very reliant on for the last 10 years. But we've got to remember that the forward guidance, to the extent that we've had for those over that time, is not something that's been there for a long time, been there beyond really the global financial crisis. We've always had to rely on the data. We've always had to rely on monitoring the situations and try to kind of determine where we think interest rates are going. Forward guidance was a very useful policy tool when interest rates were at 0%, because policymakers wanted to ensure investors believed that they were going to be at 0% for a prolonged period of time, and just stating that wasn't having enough of an impact. So they really wanted to drive that home, that it's like the kind of time period we were looking at 0%, providing that confidence to businesses looking to borrow, providing that confidence to households as well. And ensuring that markets abided by that and kept rates low. Well, that's no longer the case. And in fact, while central banks could have said with a strong degree of certainty that interest rates were going to remain low for the next couple of years, for example, back in 2012, they can't tell you where interest rates are going to be in 3 months' time at this point. So what good is forward guidance? So retiring forward guidance for now, I think, is a positive thing. And I think other central banks either have or will follow that trend, and we're going to have to go back to a situation where we're watching the data and trying to make our own minds up and see if it aligns with the view of the central banks. And yes, central banks will still offer some form of loose guidance in terms of where they believe roughly interest rates were going to go. Australia alluded to that. We could see 25 basis points again. It could be 50. It's not off the table. That is a very loose form of forward guidance, and the Fed, I think, is still going to continue to do that. But I do, again, wonder how long they will continue such explicit guidance for. But I think this is a positive step, because I think we've become overly dependent on the forward guidance of central banks, and we also hold them to account far too much, like they are not forecasters, like they can read the future. And I think that means that there's been a huge amount of criticism level towards central banks because their forecasts aren't always entirely accurate, but they never were. No one's forecasts are entirely accurate. They're there for guidance. They're not there as a measure of what exactly is going to happen in the future.
Now, Craig, as always, thank you very much for your insights, and thanks for coming on the show.
Thank you.
Now, we've been speaking to Craig Erlam, Senior Market Analyst, Asia at Oanda, on BizTech's Asian Midday Market Watch. I'm Brian Fernandez. This show will be on our website, www.biztech.asia, as well as our social media platforms. It'll also be on our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.